Retirement plan fees have gained a lot of attention lately, and rightfully so. There's been an increase in litigation against plan sponsors having to do with retirement plan fees. The litigation is happening in plans all the way up to billions of dollars in plan assets, all the way down to a plan with 1 million and only 27 participants. There's also been a lot of media focus attention on 401k plan fees. And also, participants are just more generally aware of the lack of transparency at times that have to do with their 401k plan fees. So this webinar today is designed to help plan sponsors understand the different service providers and then to decide, how do I find out what the fees are inside of my plan? And then we're going to talk a little bit about the personal responsibility you have as it pertains to the plan fees.
Today we're going to talk about decoding your retirement plan fees. We understand that historically, retirement plan service providers have done a poor job making these fees clear and understandable. We're going to take you through and help you locate your fees, find out how much they are, and determine if you are paying is reasonable. We want to help you minimize your fiduciary risk so that you and your participants are only paying for what you feel is truly valuable. Thank you for joining us today for our presentation, Decoding Your Retirement Plan Fees. I chose the title because I think most of you will agree that when you start trying to understand plan fees, you feel like everyone around you is speaking in a different language, and you need someone to decode it or translate it to you. By the end of our presentation, I think you'll feel more comfortable in understanding the language of plan fees, but I'll also warn you that we're not attempting to make you experts, and if you still feel like you're running into barriers, I'd recommend reaching out to your advisor or us to get help.
Hi, my name is Heather Wonderly. I'm the director of our Corporate Retirement Plans division here at Aldrich Wealth, and I also work with a lot of our corporate retirement plan clients. I help them at the trustee level with all sorts of things, including their plan fees, also as an investment advisor and helping out with employee education and advice. I've been working with retirement plans for over 15 years, and I can tell you that plan fees are maybe not the most exciting topic, but definitely have a lot of detail to them. And with me today is Jeff.
Yes, I'm Jeff Clark, a retirement plan consultant with Aldrich Wealth. I work out of the San Diego office and service most of California's clients. I've been in the financial services industry for 7 years, starting off as an individual financial planner where I earned my CFP, and over the past couple of years I've transitioned to working with corporate retirement plans. So our agenda for today is we're going to go over why you should care about the fees in your plan, talk about the different types and how to locate them, talk briefly on what is reasonable fee, because that's what matters by the Department of Labor's standards, and then we'll go through what are some best practices to minimize your fiduciary risk. And at the end, I understand we won't be able to take questions, but if you need to follow up with us, we'll leave you our contact information. Just to understand, before we go too much further, reasonable means the standard when you're talking about participants paying for fees. So if the business is paying for all the fees, then I guess you're welcome to pay unreasonable fees. But for the rest of this presentation, we're going to assume that the fees we're talking about are at least partially or fully paid by participants. So why should you care? Well, the first thing is you're probably a participant yourself in your own plan, and you probably don't want to unnecessarily hurt the growth of your investments. So obviously excessive fees can diminish the investment growth and harm participant retirement readiness. Even with just a small amount of fees, you can see in this chart here with someone that started with $100,000 and had an annual return of 6%, the difference between no cost and even just 0.25% is about $40,000. So a little bit of fees over time can really add up to quite a bit. It is really like compound interest in reverse. But the other thing that you should care about is because your employees care about their fees. There is more information out there amongst participants. One reason is because of the Department of Labor in 2013 started instituting disclosure notice rules that plan sponsors must provide to their participants through a 404A5 fee disclosure. So they're getting more information about what's in your plan. They're also, just by the natural shift of, I'd say, the environment around what is probably called the Vanguard effect, more people know about low-cost index fund strategies and are aware of that, and they're looking for that in their retirement plans, and they're focused on fees. And then also just the general media. You can see here there's a video from John Oliver, a very late-night comic host, talking about some things as boring as fiduciary and retirement plan fees, but it's out there. And if you just do a quick Google search, you'll see these headlines. Do you know how much you're paying? Are you're paying too much? And sometimes these headlines are a bit much. This last one I really like. Hidden 401k fees can destroy your retirement dreams. So there's a lot of we're somewhat of the whipping boy of the investment space over the last 10 years, I'd say, because there was a time when fees were quite high in our industry, and they've been slowly coming down, but there's definitely a tension there. And then lastly, why you should care about your fees is because the Department of Labor says you should. If you are a fiduciary, you must adhere to the rule that you act exclusively in the best interest of participants. Now, we're not going to go into too much detail today about fiduciary, but I will point you that we have another video available called Fiduciary 1.0, and I would encourage you to go check that out. But some of the basics that we cover in there is the duty of prudence, following plan documents, diversifying assets, and then today we're really focused on the duty to pay only reasonable fees. Again, the reason why you should care is that fiduciaries are personally liable. So if there is a breach, if you do not pay reasonable fees, and if there is harm done to your participants, then you could be personally liable for those losses. In the news, you probably have heard about a lot of litigation, and this is just a short list. The list could go on and on, but there are a lot of cases out there. There's an increasing number of cases developing around fees, and I'll just kind of highlight the evolution of these cases over the past maybe 10 or 15 years. They started out with cases involving plan sponsors being asleep at the wheel, just generally not really paying much attention to their plan. They might have had late deposits, or they weren't following plan documents, not meeting regularly with an advisor, or even really monitoring or tracking the funds or making many changes. Those were sort of the first set of cases. And then they moved into cases around share classes and unreasonableness of fees. These were ones where plan sponsors were not using the lowest cost share class available to them. They didn't know how much they were paying to their providers. There was a lack of transparency, and sometimes we hear this, that some plan sponsors think that their plans were free, and that's just simply not the case. So that was the second sort of evolution of these cases. And then most recently there's been cases involving self-dealing, which is where a lot of investment companies, like you see on here, Fidelity is listed as one, Nationwide Life, they were doing what's called self-dealing, where they were putting their own investments in their plan, proprietary investments that were to benefit them. So what you can see here is that, yes, many of these cases involved very large size plans, and that typically is what the plaintiff's attorneys are going after because it's the biggest payoff to them. But we've also seen this kind of move down in scale to where some of the smaller plans are also getting cases brought up as well. One thing that you could say is a benefit to all these cases, that the good news, I guess, is that since 2000 to 2014, there's a research report that said average fees paid by investors have declined by about 30%, coming from the Investment Company Institute. So that's the good news, is that some of these cases has had the effect that fees have come down, and they've come down most in the smallest plan spaces. So typically plans under 1 million or 1 to 10 million, in that range, have seen a big decrease in their plan fees. Next, we'll go through the different types of fees. Just want to cover some definitions before we get too much further into this. First is an asset-based fee. And what that means is that fees are going to be determined as a percentage of the assets in the plan. So you will see 0.30%. We often might call this 30 basis points, just to, for the vernacular, it's a little bit easier to say. These fees will be applied either pro rata or per capita. Pro rata means that everyone pays the same percentage, but in nominal dollars, of course, the larger your account balance, the larger the payment is going to be. Per capita would be the opposite of that, where each participant will pay the same dollar amount, but that would pretty much hurt those with small balances, sort of newcomers to the plan, more than people that have been in the plan longer. So we don't see that a lot. We typically see pro rata. Flat fees is another way. You just a standard dollar amount fee, and so for a $10 million plan, say if you had a $30,000 flat fee, it would come out to 0.330%. As the plan would grow in size, that fee would stay the same in dollar amounts and would also become less as a percentage over time. Often you will see breakpoints where a service provider may begin to reduce their asset-based fee at certain levels. So as the plan grows into, say, above 5 million or above 10 million, they might offer a reduction in their fee. Now, the arrangements for these, some fees can only be paid by the employer. These are called settlor fees. such as legal fees, anything around deciding to establish a plan, designing the plan in a way that either you want to run projections about whether you should be doing safe harbor or profit sharing. Those are the types of things that must be paid for by the business. Now, the other fees involved in the plan can be paid by either the employer or a combination of the employer and the participants, or also solely by the participants. And those would be things that actually have a benefit to the participants, like record keeping, compliance, advisors, and the education that gets done in the plan. Those are the things that can be shared with the employees. Of course, the one fee that is solely paid by employees that cannot be paid by the plan sponsor is the investment costs, the investment expense. Now, the indirect fees are a little bit harder to understand. It's not necessarily as clear, but revenue sharing is the practice of adding sort of a non-investment related fee on top of the existing mutual fund expense ratio. These are commonly called 12B1 or sub-TA, and they have in the past been used to help pay for different services, often an advisor or a record keeper, but they're sort of stacked on top of the investment expense and not explicitly pulled out separately. The process of fee equalization is to do that, is to separate or remove that portion of revenue sharing and give it back to the participant who invested in that mutual fund. If that cannot be done, and some record keepers are unable to do this, what they often can do is pull it aside but put it into one sort of bucket. It might be called an ERISA bucket, and so in aggregate those funds can be used to offset expenses, but maybe not done at the individual participant level. And just a little case study here, we actually had gone through multiple record keepers that we worked with, and we thought that the definition that we believed fee equalization, like I mentioned, where the money gets deposited back or credited back to the participant, in one of these cases we actually were surprised to find out that it wasn't what we had thought, and the money was going into a bucket, and not only was it not being used individually to offset expenses, but it was actually only offsetting the employer's expenses, which is really different than what we had thought. So it's often good to run an audit of how these are actually being done so that you're offsetting employees' costs and not employers.
Yeah, thanks, Jeff. I just wanted to talk a little bit about the different types of fees that are inside of a plan. So Jeff kind of outlined why fees can be bad, but obviously no retirement plan is free. There are a lot of different service providers that are involved inside of a retirement plan. And as far as I am aware, none of those types of providers are not-for-profit. So most of these providers operate in a business sense in that they do need to charge for their services. So the different types of services that are available for a retirement plan, obviously the investment advisor, and this role runs the gamut in terms of what services are provided, and we'll talk a little bit about that in a future slide. The record keeper, also the custodian, the third-party administrator, or the TPA, not to be confused with the capital P, capital A plan administrator internally with the plan sponsor, the mutual fund managers, and then also often an ERISA attorney as well. So an investment advisor, often associated with the plan, can provide a variety of different services. I think the one that's most obvious is the investments. So an investment advisor will often recommend, in the case of a 321, or select, in the case of a 338, the investments that are available for the plan participants. They will often then monitor those investments and replace them when necessary. Other things an investment advisor might do, they may meet with the trustees on a regular basis. They may design the investment lineup for the plan. They may help with the QDIA, the default for participants who do not select investments themselves. They may help what type the plan should have, and then going forward decide what product should fill that QDIA space, and then continue to monitor that QDIA. They may help with investment policy statements. They may help with vendor searches, vendor just resolution and monitoring and that sort of thing, just kind of troubleshooting for the overall plan. They may also provide participant services, so they may do employee education. They might do that with one-on-one with people. They might do it in a group setting. Some act as a fiduciary with respect to participant advice, and others don't. They will simply provide education. and some advisors will help with fiduciary governance. And the reason that I go into some of these different services for each provider type is that we're going to go into a little bit of detail about how to determine if your fees are reasonable. And part of determining whether they're reasonable is knowing what services you're being provided for the fee that you're paying. The third-party administrator in the plan, this is most often associated with doing the annual compliance services. So the required calculations, the ADP and ACP test, they often will submit and prepare the annual Form 5500. They'll help with plan design, doing projections, trust accounting. They will also help often with any kind of corrections that need to be made during the year. So that's a function of the third-party administrator. Oftentimes, the TPA fees or the TPA functions will also be with the record keeper, so that can be bundled or it can be unbundled, and knowing the difference and knowing what you're paying for is important there too. The record keeper is the service provider that most folks associate with being their, quote, retirement plan. So it's the website interface. It is the entity that is most often found on the participant statement. So from a participant standpoint, often they associate the record keeper as being their retirement plan provider. So examples of this would be, Fidelity, Empower, Transamerica, John Hancock. We have some other examples there at the bottom, but this is the entity that's keeping track of whose money is whose. They provide that daily valuation of the assets. They provide the statements. They do process, different types of distributions, loans. They sometimes will answer participant phone calls. It depends on the record keeper, but that's the kind of function of the record keeper. The custodian is usually associated with, in some form or fashion, with the record keeper, but the custodian is a separate entity that holds the assets and trusts and receives the payroll contributions. And typically there is a fee separate from the record keeping fee or can be bundled in with the record keeping fee, but certainly every plan has to pay a custodial fee of some sort. Some examples there at the bottom, Schwab and TD and Vanguard are common. Most insurance-based record keepers also act as a custodian as well. You also have, obviously, the costs associated with the mutual funds inside of the plan that are offered. So this will vary at each mutual fund will have its own expense ratio. Some are active or more expensive. Passive is less expensive in general. Jeff mentioned the kind of Vanguard effect of plan sponsors racing to use passive funds because there's this perception that using index funds because they're inexpensive will somehow keep you out of trouble, which I think is a myth and not necessarily the case. But then there's other investment services that can be offered as well. Managed accounts is another one. So a variety of different services that can be offered to the plan. Now, whether or not these are all offered to your plan that's part of the investigation that every plan sponsor has to do, is what services are out there, what's being provided, and then what you need in terms of your plan. Some plans also have an ERISA attorney as well. Some do not. ERISA attorneys can create plan documents for their clients. Other times the record keeper will provide that plan document, or maybe the TPA will provide the plan document. Certainly an ERISA attorney can help with any sort of legal issues that come up and can explain and apply the ERISA law for your particular plan. Are we having fun yet? I hope you guys are all still with us. We are certain that this is not a fun topic for you, but it is definitely an important topic for your plan, and we hope that you are still with us and that we can stay on track and show you some very good examples and go keep going. So, Jeff, I'll hand it back to you.
All right. Well, as Heather was saying, one of the hardest parts when you've got these different fees and they sometimes are bundled together for multiple types of services is trying to separate these out. We want to really get transparency on what service and what fee is being done, not all bundled together. So what I'd recommend is starting with some sort of worksheet where you can organize all of this and start with identifying, one, if the expense is paid by the business or if it's paid by the plan, which is the participants, and start creating a list. And also, I think you want to keep the same format. So here we're using an asset-based fee to compare everything. We want to compare apples to apples, and eventually what we're going to get to is a point where we compare your plan to some sort of benchmark, the rest of the industry. So I think an asset-based way is a good way to start. And you can see that the breakdown here is we've got the advisor fee, the record-keeping custodian, the TPA. Revenue sharing would be money contributed put back into the participant's account, so that's a negative. And we come up with a total bundled fee. One thing to point out with the weighted mutual fund fee, obviously each mutual fund in the lineup has their own expense ratio and their own set of revenue sharing, and they're all going to be different. And so what you want to do is not just take, I mean, you could, at starting point would be take a simple average of all those funds. Let's say you have 15 funds in the lineup, you take an average of them. But more realistically, if you want to compare to other plans, you want to weight that towards what people typically hold in a 401k, which is, you know, might be 60% stocks and 30% bonds and 10% money market or fixed account. So you want to start with a straight average, but then to get more detail, you want to go towards a weighted average. Also, we're not going to include in this sort of analysis any sort of non-recurring fees, just transactional types of plan design consulting or plan amendments. We're going to leave that out. We're just going to go with ongoing, repeated fees each year. So the first place to look to locate these, the best place is going to be your service provider contract. When you sign up to work with a service provider, they're going to have a contract that's clearly going to state the fee in terms, either asset-based or flat dollar amount, and they're also going to state what services are going to be provided. That's the best place to start. And here's an example of one that's from a TPA, and they list out what they're going to do. They're going to provide annual compliance, doing contribution calculations, non-discrimination testing. They'll do 2 hours worth of trust accounting, and prepare the annual Form 5500, and for that they're going to charge a base fee depending on the number of participants in your plan, and then after that base fee comes a per participant fee on top of that. So what I would do is figure out your number of participants, come up with that dollar amount, and then you're going to again try to translate these into an asset-based fee, divide that dollar amount over the total assets in the plan, and you'll get that asset-based fee. The second place to go to is an invoice. So if you're already working with a service provider and you've been with them for a while, every quarter or whenever they bill you, they send you an invoice. You can take that dollar amount that they're charging you, whether it's reported in dollars or reported as an asset-based fee, and that's a good start to figure out what you're paying. Now, you may not get from that the most detailed description of what services that are included as you would get in the service provider contract, but at least gets you started on how much you're paying. Now the next one, these disclosures, 404A5, again mandated by the Department of Labor, is a good place to go for some things, but depending on how these things are designed, you may not have the most clarity with some of these. So one of the things I like getting from a participant disclosure notice is the investment fee. So on the right-hand side, you can see the gross and net investment expenses. For example, this Goldman Sachs fund has a 1.02% gross investment expense. And compared to earlier when we were talking about gross and net as in revenue sharing and how the net would be after the revenue sharing, this is slightly different. This is where the mutual fund company has said, you know, in some cases our funds were offering a little bit of a waiver on some of our fees, so that's what that net expense is. So don't confuse that with revenue sharing. We'll get to that in a second. Also with the 404A5 participant disclosure, you're going to have that column in the chart in the upper right is what each revenue sharing component is for some of the funds. Not all of the funds may have revenue sharing, so just some will. So what you would do, for example, with the Artisan International Fund is you would take that gross expense ratio that's reported and subtract this 0.35 from it, and you'll come up with a net expense ratio to then further analyze the investment costs in the plan. In the bottom left section is other services that can be done, such as loan maintenance fees. These are sort of one-off situations, so we wouldn't use these as a regular thing to analyze on a regular basis. Doesn't mean you should ignore them. You want to make sure that some of these charges aren't egregious, but typically these are not something that come up that often, and they don't tend to be that high of cost anyway. This next disclosure is one that comes from the service provider to you, the plan sponsor. It's called 408B2. These also can be sometimes hard to read. In this example, we've got one from a record keeper, and unfortunately it's kind of like a treasure hunt to try to figure out where everything is. And you know, they've got a formula up there, A plus B equals 0.27%. And what's happening here is there's a lot of bundled services going on. There might be record keeping services, there might be some aspect of revenue sharing that's going towards the record keeping or going towards the advisor. So it's a little hard to break these down. If you can't figure it out, which in some cases we can't even figure it out, it does require probably a call to that service provider to get more clarity on what's going on. And if you can't get the bottom line answer, you probably should bring in a consultant or someone that can really read these well. This is sort of the same plans, record keeping, just breaking it down with these different columns. They've got the investment expenses. Again, here's these revenue sharing that I mentioned are on top of the investment expense, the 12B1 and column, this is column 2, and the sub TA fees. And all of these, kind of hard to follow the math, but bottom line here is there's probably a required revenue that this record keeper needs, and in this case it would be 0.60% in column 4. So no matter where the money comes from, whether it's from the participants, whether it's a higher investment expense, they're gonna require that 60 basis points of revenue. They just don't really care where it comes from. So clear as mud, right? This stuff I know is frustrating, and I hope at this point you haven't given up. At least you know where to go to locate these. Now let's move into, you know, sometimes you want to just bang your head against the wall. It is frustrating, I know. But let's get into what is reasonable and then how we can protect ourselves against risk.
Thanks, Jeff. It is definitely frustrating, and even for folks like Jeff and I, who this is our job and this is what we do, you know, every day, all day, when we sometimes get some of those disclosures from the providers, we sometimes have to make a phone call or to make sure that we're, you know, on the right track in terms of the treasure hunt that Jeff mentioned. So it certainly is not easy. We wish that it was. It should be easy. There's reasons why the industry is the way it is, unfortunately, and we think that there's definitely progress in this regard, no doubt. But progress is slow and definitely not the easiest thing. So we do hope you're still with us. Now we know what your fees are. Let's assume you've gotten to the bottom of what they are, who's being paid what, and the services that are being provided. So the last kind of question in your mind is, what is reasonable? What is a reasonable fee? And unfortunately, ERISA doesn't spell it out for you. It doesn't say, oh, as long as it's under X amount or X percent. There's no formula. It's very facts and circumstances, and it's unique to each plan. One thing we've noticed is that plan sponsors are quick to assume that as long as they have the cheapest record keeper, cheapest investment costs, that somehow that mitigates their risks. And that's actually not true. As a fiduciary to your plan, you're actually responsible to hire any services that you cannot do yourself. You're responsible to make sure that you get all of the services you need in order to operate the plan in the best interest of the participants. So it's a matter of determining what services you're receiving and then the cost that you're paying, and they have to be reasonable based on that alone. Our best advice is to read your service agreements and understand what you're paying for, and ask your service providers a whole bunch of questions. What are they doing for you, and is it necessary? One example that I have is that, you know, we can work with any record keeper, and so we have quite a few different record keepers for our different plan sponsors. And when we talk about record keeping services with our plan sponsors, there's a gamut in terms of the technology that's available at the record keeping level. So the website could be really fancy and have a lot of bells and whistles and calculators and things to help participants to determine whether they are going to be ready to retire, if they're on track. But if your participants never use the website, if they don't have access to computers, if they don't use their smartphone, if they're just not going to use it, then you shouldn't probably pay for that level of bells and whistles. Another plan sponsor who has an employee base that would value that and it would really help them to get on track for retirement, then maybe it is, you can justify paying a little bit more for the record keeping expense because it's going to be in the best interest of the participant. So definitely cheapest is not best. Most expensive is not necessarily best. It's really is unique to each retirement plan. Benchmarking is one way to determine if your costs are reasonable. There are a variety of different benchmarking tools. I will say this, that none of them are perfect. One of the things about the benchmarking tools is that they don't talk a lot about the services provided for different fees. Usually they're taking national averages for a variety of different services for different plan sizes based on the assets typically. So it's one way, and it's valuable to a point, but it's not going to do much in terms of giving you some sort of a way to determine how much other providers are going to charge you for the same type of service. Which is why still the gold standard is probably doing either an RFI or an RFP. So going through the process can be a little bit painful, but every few years we do recommend that you evaluate what services your plan needs and then go out and ask service providers to provide you with a quote for those services so that you can compare and make sure that you're doing an apples to apples comparison for the services that your plan needs. Another really important piece to the equation for determining whether your fees are reasonable is this share class review. And this is where a lot of the recent litigation really lies, is looking at, is your plan utilizing the cheapest share class available to it? And the cheapest share class, how you define cheapest can depend. So Jeff has mentioned equalization. So if you take any revenue sharing and you give it back to the person who paid it in that fund, compare that type of situation, your cheapest share class will be different than if you take that revenue sharing and you use it to offset the record keeping fee. That will produce a different result in terms of cheapest for the plan participant. So there's a lot to this, and we recommend that you pay close attention to that share class review. The other piece is the auditing of the fee equalization if you are doing that. Making sure that you take a little bit deeper dive, at least annually, and have some test cases where you make sure that the revenue sharing that is being rebated back is correct. We actually have done some audits and we found that it's been incorrect in the past where the record keeper did not provide the revenue sharing that it was saying that it was providing. So we definitely think it's a good idea for plan sponsors to provide documentation that they audit that annually. Certainly this is a very complicated topic, and hopefully we've given you a little bit more clarity, but certainly it is a bit clear as mud. And so we would welcome you to contact us with any questions that you might have. We're happy to answer any questions about our presentation. Jeff, did you have anything to add?
Just definitely keep this a record that you attended today's presentation. You'll want to put that in your fiduciary file. It's always good to show that you've received training on this stuff. In case there was ever an audit, you can say that you've been through some training on fiduciary matters and fee, understanding your fees.
All right, well, thank you for joining us today, and we look forward to chatting with you next time.